Hello and welcome to this session in which we will discuss the importance of cash flows in creating values. Now, emphasizing the importance of cash flow is self-explanatory. Cash is king. Without cash, you cannot survive. Cash is the oxygen for any business. But in this session, I am going to show you how cash flows fit into the objective of the financial manager role, and how do we create value from cash flow, or how does cash flow create value to the firm, to the company. So the objective of a financial manager is to do what? Is to create value. Through what? Three things, and we discussed those in the prior session. Once, the financial manager makes capital budgeting decision. What's capital budgeting? Buying property, plant and equipment, warehouses, simply put, long-term asset, computers, programs, software, servers for the company to survive in the long term. You need those assets. Two, financing the company. Financing means what? Choosing between debt, borrowing money, and issuing stocks to finance the company, financing the company. And three is net working capital, running the company on a day-to-day basis. Those are the three decisions that the financial manager will have to conduct in order to create value for the shareholders. So how value is created? Well, when you acquire those assets, property, plant and equipment, those assets will have to generate more cash than cost. And this is called capital budgeting decision. We'll have a whole session about this. We're simplifying here. So one way to create value, if you purchased 1 million worth of property, plant and equipment, you want to have a return more than 1 million, more than when you invested. Issue financial instrument that raise more cash than its cost. When you sell equity and debt, when you raise money, for example, the investors gave you $5 million in debt and equity, you want to pay them, for example, 10%, but return more than 10%. So you want to get more return for those investments than what it costs you. So if it costs you 10%, you want to take this $5 million and invest that money in the business and earn 15, 20, 30, anything but 10%, greater than 10%. So the key principle, if you want to summarize it, is to generate cash flows than it uses. So the key to any company is to generate more cash, positive cash, than negative cash. So basically you want more cash coming in than cash leaving the company. That's the basic idea. Now we're going to look at a picture here, and through this picture I'm going to show you from a grand perspective, from a macro perspective, what do we mean by cash in, cash out. So we would emphasize, we will display, we will explain this graph, and we have several steps: A, B, C, D, E, and F, and I will show you exactly what do we mean by that. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Our corporate finance course is best for online students and students who are taking corporate finance courses. We cover financial statements, discounted cash flow, stock valuation, bond valuation, NPV and capital investment decisions, cost of capital, risk and return, as well as other topics. Our course includes lectures as well as multiple choice questions. Go ahead and start your free trial today. No obligation. We are here to help. Your success starts here. Let's think about Farhat Lectures. Farhat Lectures is the company, and Farhat Lectures wants to start a business, and that business in the startup accounting and finance education to small businesses. That's Farhat Lectures. Now Farhat Lectures needs money to operate. Why? Well, I need a server, I need a website, I need an office to house my employees, so on and so forth. I don't have the money. So what I would do, I will go to Wall Street, and notice I have Wall Street in quote. I go to the technical word is financial market. I'll go and ask people for money. They will ask me, tell me about your plan, show me your financial statement, show me your business plan, when do you plan to turn profit, so on and so forth. So I will show them, Farhat Lectures will show them, and as a result they are going to give me money. So to launch operation, I was able to raise $5 million by issuing equity and debt. So the company received $5 million from two groups. stockholders gave us 2 million, and lenders gave us 3, in total of 5 million. So this firm raising money through the financial capital market. So this is provide funding in form of equity and debt. And that's usually the first step. Now in the real world, when the company starts, usually the owner themselves, I will invest my own money to start my business, get it up and running, make it profitable, successful. Then if I want to grow and if I need funding, I will go to the financial market. So, but now I'm simplifying this so you understand this. Okay, now we have 5 million. Remember, we got 5 million from the financial market. What do we do with this money? We are going to invest in assets. We're going to invest in various assets and operate the business to generate more cash. So we're going to invest 500,000 in office equipment and a website. We're going to hire developers, marketers to create content, market our product online, salaries of 2.5 million plus benefits. And we're going to develop a proprietary software, a learning management system that costs us 2 million. So what I did here is I took this 5 million and I spent every penny of it in creating value, not value, in acquiring asset that I need to run the company. And I spend this 5 million. So these are the firm's investment in productive assets. Now again, remember, employees are not assets from a accounting perspective, but from a managerial finance, we can go with that. And I purchased both tangible and intangible asset because this, the proprietary software is an intangible asset. It's a code. So this is what I did. What happened next is I run the company and I generate cash inflows. After 1 year of operation, I gain popularity and Farhat acquires 5,000 clients, generating 7 million in subscription revenue. Now what happened is I have 7 million, and let's assume this is all cash profit. 7 million, and rather than revenue, I'm going to call it cash profit. And we're going to define what cash profit is. So this is the cash inflow from the firm operating activities. Great. This is exactly what we wanted to do. We promised the investors, the creditors, you give us money, we're going to make money for you. And that's exactly what happened. Now this is C. What are we going to do with this cash? Now this cash, the first thing we have to do, we're going to pay Uncle Sam. We're going to pay the government. So D, after we make this cash, we are going to pay taxes. That's $1 million because we have to pay our obligation. There's no way around this. Then some of the money from the profit we are going to reinvest in the company. We decided to go back from that $2 million, from the 7, we're going to pay 1 million to taxes, so we're left with 6. From that 6, we're going to keep 2 million invested back in the company for internal growth. We are going to retain $2 million. Why? Because we might need to hire more content creator, more developer, spend more money on marketing. We need this money for internal growth. We kept 2 million of that. So 7 minus 1 minus 2, we're left with 4 million. Then we are going to pay the sum of the money to the investors. We're going to pay 200,000 in interest for the people that lend us the money. We're going to pay back 1 million in debt and the principal, and we're going to issue 800,000 in dividend. You know what? Since we've started with 7, let me go back and pay some debt off. 1 to the government. I'm left with 6. I'm going to keep, we said retained earning is 2. I'm going to left with 4. And what I'm gonna do with this 4, I'm gonna pay 200,000 as interest. As this 200,000, I'm gonna keep it the same, and I'm going to pay 800,000 in dividend. 800,000 in dividend. That's $1 million. And guess what? Rather than 1 million, I'm gonna pay 3 million in principal. Well, hold on a second. Did I borrow 3 million? I didn't even borrow 3 million. Let's make the numbers make sense because I don't want somebody calling me these numbers don't make sense. Let me show you how much money I borrowed from the beginning, and this way it's more realistic so you can follow the example in realistic figures. So I paid off my debt. How about that? Great, perfect. So the 3 million is I paid off my debt. That's great. I just had to pay. So what I did, I made this assumption that I paid off the debt. If I didn't pay off the debt, then I will have 4 million in retained earning. I don't need 4 million. I'm going to pay off the debt. So my debt is all paid. Great. So this is what happened. We started with some cash, invested the money, and we made more cash. Now, I kept emphasizing the word cash, and I told you focus on cash. In the real world, we have something called accounting profit versus cash flows. In accounting, you learn all about accounting. When it comes to finance, you will be hearing this term, cash flows, because what matters at the end of the day for a financial manager, if you are running the company, if this is a corporate finance course, if you want to run the company, you need cash. You cannot pay your profit with net income. Why? Because net income could be accrual. This could be a figure. From an accounting perspective, you are profitable, but from a cash flow, you are not. Let me explain an example. Let's assume a company called SilverPoint Technologies, and what they do is they design and sell high-end computer chips. At the end of the year, they sold 1,000 units to various distributors for $500,000. As far as we're concerned, that's revenue. The company paid $400,000 in manufacturing costs to manufacture those chips. Now, from an accounting view income statement, the company generated $500,000 in sales, incurred the cost of $400,000. They have an accounting profit of $100,000. From an accounting view, they have a profit. Now let me show you from a cash view. Now I'm going to keep the heading the same. I'm going to scratch income view to cash view to remind you. From a cash income statement, they have no cash. Cash inflow is zero. Why? Because we sold those to distributor and we sold them on credit. The customer has not yet paid. In business, we have to do that. Sometimes we have to sell our product and wait 30, 60, maybe longer for something to get paid. Nevertheless, from an accounting perspective, that's revenue. From a cash flow perspective, it's not revenue until we actually receive it, because cash is cash. It's nothing else. So from a cash perspective, we are cash poor. We are broke for $400,000. You might be saying, how would the company survive if they are negative $400,000 cash? Finance. They will borrow money. They will ask the investors to put money. And if the investors believe in the company, they believe we're going to get the $500,000, they will invest because we're going to make a profit. So this is how it works. Let's take a look at this multiple choice question from farhatlectures.com. An example of cash outflow is when a corporation collects customer payment. No, that's not even a cash outflow. That's an inflow. A is out. B, borrows money from the bank. That's also an inflow. When you borrow money, you're bringing money. Pays cash dividend. That's an example of an outflow. Yes, this is an outflow. Now, eventually, you're going to have to learn that collecting payment customer, that's inflow from operating. Borrow money, that's inflow from financing. Pay cash dividend, that's an outflow for financing the company. And declare stock dividend, actually, it's not even cash. It's a stock. You're declaring stock dividend. That's out. That's out. B is not even cash. C is the correct answer. What should you do now? You want to go to Farhat Lectures, look at additional resources, whether you are a finance, accounting, studying for the CPA, CFA, CMA, or any other professional certification. Invest in yourself. That's the best investment you can make, and good luck.